Greetings. We're here to present to you Nike's Global Fraud Risk and Vulnerability Assessment. I am Felicia Taylor, a fourth-year accounting student from Fort Lauderdale, Florida.
I am Sydney Stargle, a fourth-year accounting student from Columbia, Maryland.
And I am Blake Bell, a graduating senior from Tallahassee, Florida.
I am Ashanti Thompson, a fourth-year accounting student from Fredericksburg, Virginia. Our presentation will first cover inherent fraud risk. This section will describe how fraud levels were determined, address key accounts, and the types of fraud schemes that use these accounts. Second will be our financial analysis. This section will discuss fraud risk for the key accounts, key ratios, and how to detect fraud using ratios and analysis. Third, we will cover the fraud risk assessment, where we will address definitions, examples, motive, red flags, prevention, and detection of fraudulent schemes. Lastly, we will discuss the final risk assessment, levels of overall fraud risk, the controls towards prevention and detection, and how the company plans to move forward.
Internal fraud risk is determined by evaluating how much risk there is that fraud could be present in each of the line items of the financial statements. The internal fraud risk does not take into account any internal controls that the company has in place to mitigate fraud. For each line item, we evaluated the internal fraud risk as high, medium, or low, and provided an explanation for our decision. Cash and cash equivalents has a high inherent fraud risk because it is very susceptible to theft. Some schemes include cash larceny, fraudulent disbursements, and skimming. Next, we evaluated inventory. Inventory also has a high inherent fraud risk because it may be overstated in order to make the company appear better than it is. Some fraud schemes include double counting, overestimating, and overstating. Inventory is also susceptible to being stolen by employees.
And moving on to the income statement, there are two types of accounts we would like to focus on, and that's revenue and cost of goods sold. Dealing with revenue, we deem that to have a high inherent risk, and that's because of the high transaction volume and it's susceptible for manipulation. There are various types of frauds that could occur within the revenue, for example, fake sales or channel stuffing. Moving on to cost of goods sold, we believe that to have a high inherent risk as well. When considering inherent risk, we look at the inventory, and if inventory is overstated, then cost of goods will be understated.
In our financial analysis, we performed a vertical, horizontal, and ratio analysis to evaluate three financial statements: the balance sheet, the income statement, and the statement of cash flows. We were able to detect possible fraudulent activity by focusing on the unexplained increased and decreased percentages found in our analysis.
For all of the financial statements, we determined that anything over a 5% increase would need to be further investigated. On the balance sheet, I would like you to look at some key line items that we determined would need to be further investigated. AR is the first one, accounts receivable. As you can see, there was a dramatic decrease in accounts receivable for this fiscal year. We need to further investigate this to ensure that there are no fictitious receivables that were recorded this fiscal year or previously. AR also presents as a red flag because of the inherent risk and the ease at which it can be manipulated. Moving on to the current portion of long-term debt. Liabilities are often based on large amounts of estimation, and we want to ensure that what is recorded as current is actually current, and thus it would need to be further investigated. Moving on to the income statement with our financial analysis, I would like you all to look at the revenues account. Revenues can be easily manipulated, and revenues also present a red flag because of the number of alternatives when doing revenue recognition. Dealing with revenues, it is important not just to take a sample of the data and information, but to look at the entire population, including all of the source documents, to ensure that we are covering all our bases and looking at every aspect to make sure that there is no fraud present. And looking at cost of sales now, cost of sales has a direct impact on net income. If you understate cost of sales, it will ultimately have an effect on the position of the company. This relationship is what we want to focus on in determining that all the cost of sales is valued correctly and is reported correctly on the income statement. This relationship and the effect that it could have on net income causes us to want to further investigate to make sure that there are no further fraud concerns. Gross profit deals with both revenue and cost of sales. So once we investigate revenue and cost of sales, we'll be able to determine if gross profit is accurately reported.
Within the statement of cash flows, I want to bring your attention to some key accounts and explain how we determine that there are possible signs of fraudulent activity. Let's look at the prepaid expenses. As you can see, there has been a dramatic change from 2011 to 2012, and from 2012 to 2013, with 2012 being the major difference. This decrease represents a charge to the income statement for which there was little cash outflow in the current period. A red flag could indicate that Nike was using expense-related fraud schemes to cover costs of fraud in 2012. While this does not definitely signify fraud, it could be reason to further investigate. Moving on, some key ratios that can signal a red flag are inventory turnover, which is a good indication if there are fraudulent activities occurring. If cost of goods sales increase because of theft of inventories, this ratio will be extremely high, which can signal embezzlement. The decrease from 2012 to 2013 is a positive signal to us that their likelihood of fraud is decreased as it relates to inventory. Profit margin ratio provides indication if there are false expenses. They will cause an increase in expenses and a decrease in profit margin ratio. Therefore, if there is an overtime and the ratio is not consistent, that would signal a red flag. However, you can see that over a 3-year period, this ratio has remained the same and does not provide reason to have fraud occurring. Sudden increases in the inventory sales ratio can show that a company may be inflating assets like inventories. Although there has not been a sudden increase in this ratio, it is still important that we conduct further investigation because the assets associated with this ratio are highly susceptible to fraud.
Here we're going to discuss fraud risk assessment. We're going to address fraud schemes, provide a couple definitions and examples, some possible motives to commit fraud, a couple red flags that may come about in fraud, prevention and detection to help understand Nike's overall fraud risks.
Now for fraudulent financial reporting, I will discuss improper cutoff, sham scales, and bill and hold sales. Improper cutoff happens when sales are reported in the wrong period. Typically, a company will put sales from the beginning of the current year on the financial statements for the prior year in order to overstate net income and make the company appear to be doing better than it is. Auditors should pay particular attention to sales that occur at the end of the period to ensure that they have been recorded in the current period. Now for sham sales. Sham sales are when fictitious sales are recorded on the books. This scheme could be committed by sales agents that receive compensation based on commission from their sales or by management in order to boost net income. Some red flag symptoms include customer accounts that have never had a payment posted to it and a larger than normal increase in sales. Now for bill and hold sales. Bill and hold sales are when a company sells goods to a customer that is not ready to receive them. If the company still recognizes the sale, even though it has not yet shipped the goods, then a bill and hold scheme has occurred. GAAP states that revenue should not be recognized until the risk of loss has been transferred. This scheme will overstate sales, and if the inventory being held is still counted on the books, inventory will also be overstated, leading to the understatement of cost of goods sold.
Skimming. Skimming is the process by which cash is removed from the entity before it enters the accounting system. Skimming can occur at any point where funds enter the business, so that includes persons such as salespersons, tellers, wait persons, and anybody who deals with funds entering a business. Skimming can be prevented by maintaining a viable oversight presence at any point where cash enters the organization. Check tampering can be defined as any scheme in which a person steals the employee's funds by forging or altering a check on one of the organization's bank accounts or stealing a check that the company has issued to a payee. The schemes associated with this type of fraud are usually committed by accounts payable clerks, office managers, bookkeepers, and other employees who prepare company checks. These schemes can be prevented by segregating duties of preparing and signing checks and also periodically having signers verify signatures. Payroll fraud can be defined as the unauthorized altering of payroll or benefit systems in order to gain funds which are not due. In order to detect fraud, records should be checked for anomalies such as duplicate entries, employees with other addresses, and unusual amounts entered. Prevention could include hiring an outside contractor to keep payroll up to date, establishing communications with HR, and making sure HR helps to keep payroll up to date with any changes, hires, and/or fires.
Moving on to corruption and violation of laws. There are 3 types of corruption that we will touch on, and that is bribery, collusion, and kickbacks. Dealing with bribery, that is offering, giving, receiving, or soliciting of something of value to influence the actions of an individual who holds a public duty. If a company is involved in bribery, they can easily give something of value such as cash as a form of payment and write it off as an expense. Expense accounts that have an unusual change, such as miscellaneous expense, would be considered a red flag. Collusion is an agreement between 2 or more individuals that work together to commit a fraudulent act. Collusion can happen at any level of management. The idea is to overcome internal controls. And who would understand the company's internal controls better than employees who work for that specific company. A key internal control that could help prevent this issue will be to make every employee take a vacation break. This allows a rotation within the workplace in which the fraudulent act can easily be spotted. Moving on to kickbacks. A kickback is a scheme in which a vendor pays back a portion of the purchase price to an employee of the buyer. This form of corruption usually takes place in the purchasing department of an organization. If inventory prices are increasing for certain vendors, this should raise a red flag and bring curiosity upon the organization of why prices have increased. It may be a possibility of a kickback taking place between that employee and vendor.
Moving on to external fraud. The first one, which falls in our general category, is insurance fraud. Insurance fraud is when false claims are made to insurance companies. This fraud can include auto insurance, commercial insurance, and even household insurance. This fraud can be committed by anyone who has insurance and has access to file a claim. Claims can include items that have been torched, damaged by floods, or stolen. The best way to prevent this fraud from an insurance company's perspective is to have filed claims checked by 2 independent employees to prevent any other employee from filing false claims and to double check claims that are filed by people who are insured by the company. Computer hacking fraud is committed by highly skilled computer hackers who have the ability to access sensitive and personal information from personal computers or over Wi-Fi networks. Once this information is gained, it can be used in a fraudulent manner, whether to create false identification or to apply for credit cards to make fraudulent purchases. This fraud can be concealed by using back channels or changing IP addresses so that the hacker's original location and method of hacking can be untraceable. Often, hackers do not use the personal or sensitive information to actually commit fraud. They use it to make a point and prove to individuals and corporations that their sensitive information is not as secure as they think it is. This company fraud we determined would be counterfeit goods fraud. Counterfeit good fraud involves goods and services that are passed off as originals, which are actually fake. Over the years, Nike has been the victim of counterfeit goods and services being sold as Nike originals, especially in companies like India and China. This type of fraud can be committed by anyone who has the ability to reproduce Nike products on a very large scale and the ability and market to sell those products. This fraud can be the most damaging to Nike's brand and reputation. Their brand stands for quality, and these counterfeit products often do not represent quality, and they are often manufactured in hostile and contaminated work environments. This brand damage has an effect on the financial statements. This effect will be a decrease in revenue from sales. When you sell an item, that also affects your inventory. Because Nike isn't selling its original products and people are purchasing counterfeit products, inventory will also decrease. And because inventory is originally not turning over fast enough because of these counterfeit products, the inventory that is being held to potentially be sold will become obsolete. Thus, it is important for Nike to address these issues. Now we will tell you about our final fraud risk assessment. To begin, I'm going to focus on the process that we use to assess Nike's fraud risk. This process was determining overall fraud risk using the financial statement analysis, the inherent risk analysis, and the examination of fraud internally and externally that relates to the industry and Nike as a company. This, along with understanding the company's background and important qualitative data, helps us collectively determine what the overall fraud risk of Nike is. My colleague Sydney will now explain what that overall fraud risk level is.
Our fraud risk assessment involved a very detailed analysis. Through this analysis, we were able to determine that Nike has an overall fraud risk that is high. This fraud risk is high because of several key changes in the financial statement accounts and ratios, as well as factors such as the overall size of Nike and the industry in which it operates. Now my colleague Blake will discuss how Nike can decrease this fraud with internal controls. Ashanti will also mention what next steps Nike can take involving its employees to help prevent fraud.
Based on what my colleagues previously stated with fraudulent financial reporting, asset misappropriation, corruption, and external fraud, Nike needs to establish controls that would prevent and detect the possible frauds that were mentioned. Doing so will help decrease Nike's overall fraud risk from high to moderate. We suggest that Nike focuses on controls for key accounts such as cash and cash equivalents, accounts receivable, inventory, revenue, and cost of sales. The focus will be on these accounts because these are determined to be inherently risky. Once controls have been set in place for these accounts, the likelihood of fraud to occur will decrease throughout Nike's financial statement.
Moving forward, effective fraud risk management can provide Nike with tools to progressively reduce and manage fraud risk. Here are some next steps that will help Nike move forward. The best method for Nike to move forward is to help train its employees to detect and identify fraud. This includes establishing training programs that are taught by certified fraud examiners, as well as establishing a whistleblower hotline. This is the best way other than implementing internal controls to help prevent and detect fraud.
Thank you for listening to our presentation. We hope you gained a better understanding of Nike's overall fraud risk. Again, I am Felicia Taylor, and if you have any questions or concerns, please feel free to contact us at